The stores are full, flights are sold out, restaurants are booked weeks in advance. Black Friday just shattered records again, over $10 billion spent in a single day, with nearly 95% of purchases financed. Yet at the same time, consumer confidence is near a 3-year low. Savings rates are collapsing, and credit card debt has crossed $1.3 trillion. Job growth is stalling. Layoffs are rising. Millions are working part-time because full-time jobs no longer exist. This isn't a consumer boom. It's something far more dangerous. Because when people who are running out of money keep spending anyway, it's not confidence driving the economy, it's desperation. For decades, consumer behavior followed a predictable rule. When people felt worse financially, they spent less. That relationship no longer exists. Today, financial confidence and financial behavior are moving in opposite directions, and the gap between them is widening at historic speed. Consumer sentiment surveys show confidence hovering near multi-year lows, yet spending continues to hit record levels. That is not resilience. That is a system malfunction. The data makes this disconnect impossible to ignore. Household savings rates have fallen close to 3%, less than half the pre-pandemic average. Credit card balances have surged past $1.3 trillion, the highest level ever recorded, while delinquency rates continue climbing. At the same time, real wages, after inflation, have barely grown and in many months have declined outright. In a functioning economy, those conditions would trigger pullbacks. Instead, spending accelerates. This is where traditional economic signals break. Surveys, confidence indexes, and forward-looking indicators are losing relevance because behavior is no longer driven by expectations of improvement. It's driven by immediacy. When households believe the future is unstable or unreachable, long-term planning collapses. The economy shifts from optimize later to cope now. Spending becomes detached from outlook and anchored to the present moment. Retail data reinforces this distortion. Nominal sales look strong, but unit volumes are flat. Consumers are not buying more, they are paying more. Inflation inflates revenue figures while masking demand weakness. A $100 purchase replacing an $80 purchase doesn't signal strength. It signals erosion of purchasing power. Yet headline numbers treat both as growth, feeding a false narrative of stability. This disconnect is not accidental. It is the product of an economy where prices rise faster than income, debt fills the gap, and uncertainty suppresses restraint. When people no longer trust that saving will protect them, spending stops being a choice and starts becoming a response. And once behavior breaks away from reality, the signals policymakers, markets, and corporations rely on become dangerously misleading, setting the stage for deeper miscalculations ahead. Once behavior disconnects from reality, the next question is, what replaces logic? The answer isn't optimism, it's control. In an economy where housing is unaffordable, wages lag inflation, and long-term stability feels unreachable, spending becomes one of the last actions people can still initiate on demand. Not because it's wise, but because it's immediate. Psychologists have long shown that when uncertainty rises, humans shift from future-oriented decision-making to short-term agency. The economic version of that shift is visible everywhere. The average American now faces over $1.3 trillion in credit card debt, while emergency savings for a large share of households remain below $500. When the margin for safety disappears, planning loses relevance. The economy stops being navigated and starts being endured. This is why restraint no longer behaves the way textbooks predict. Traditional models assume people pull back spending to regain stability. But stability itself has become abstract. Home prices still sit near 6 times median income, health insurance premiums are rising at 2 to 3 times wage growth, and retirement timelines keep moving further out of reach. When delayed rewards feel unreliable, present moment relief gains power. Spending becomes psychological regulation. The structure of modern payment systems amplifies this shift. Friction has been engineered out of transactions. Credit approvals take seconds. Buy now, pay later splits costs into invisible increments. A $600 purchase becomes 4 easy payments, even as interest rates on revolving debt sit near 20%. The system converts emotional impulses into completed transactions before rational evaluation can intervene. What emerges is not reckless behavior, but adaptive behavior inside a broken environment. People aren't spending because they think things will get better. They're spending because waiting feels pointless. Control over the future has been replaced by control over the moment. And when millions of households adopt that posture simultaneously, the economy begins to function less like a market driven by confidence, and more like a pressure valve releasing stress in real time. When spending becomes a tool for psychological control, it concentrates most aggressively in periods that society treats as untouchable. The holiday season has evolved into an emotion-protected economic zone, one where normal financial rules are temporarily suspended and restraint is socially discouraged. This is not accidental. It is engineered, reinforced, and monetized at scale. Holiday spending is no longer discretionary in practice, even though it appears optional on paper. Cultural expectation transforms it into a moral obligation. Retail data shows this clearly. Between Thanksgiving and Cyber Monday alone, Americans now spend over $200 billion, with participation exceeding 200 million shoppers in just a few days. Yet surveys conducted in the same window show confidence near multi-year lows. The contradiction persists because emotion overrides calculation during these windows. Retailers understand this dynamic perfectly. Pricing strategies, marketing language, and financing options are intensified during this period to exploit emotional inevitability. Deferred payments surge, credit card usage spikes, buy now, pay later volumes jump by double digits year over year, even as average household liquidity shrinks. The message is clear and constant: this moment cannot be skipped. Delay is framed as deprivation. This creates a temporary suspension of future cost awareness. Households knowingly shift risk forward, accepting higher balances, higher interest, and reduced flexibility in exchange for preserving a sense of normalcy. The economic signal this generates is deeply misleading. Pack stores do not reflect disposable income. They reflect emotional priority reordering. Spending doesn't rise because people can afford more. It rises because refusing to spend feels like failure. The holiday economy therefore functions as a distortion layer. It masks weakening fundamentals beneath a surge of emotionally concentrated demand. Once the season passes, the consequences surface quietly: higher balances, tighter budgets, delayed goals. Emotion-protected spending does not disappear once the moment passes. It reappears as a delayed cost. This is the trade-off most households never fully calculate. Every dollar pulled forward to satisfy the present quietly subtracts multiple dollars from the future, not through theory, but through math. And the math is unforgiving. Consider what debt does in a high-rate environment. The average credit card APR now sits near 20%, meaning a $1,000 balance carried for a year costs roughly $200 in interest alone. Multiply that across millions of households, and the result is not consumption, it's income leakage. Money that could have funded savings, down payments, or emergency buffers is permanently redirected towards servicing past decisions. This is how future mobility is eroded without a single dramatic event. The opportunity cost compounds beyond interest. With the median home price still hovering around $400,000, even a modest down payment requires years of disciplined saving. Yet the average household now carries revolving balances near record highs, while savings rates remain near historic lows. Each month of higher balances extends the timeline for ownership, retirement, and financial recovery. The delay is cumulative, not temporary. What makes this trade-off especially dangerous is its invisibility. The purchase feels finite. The consequence is open-ended. A holiday charge lasts seconds. Its impact can stretch years. Retirement contributions get paused. Emergency funds shrink. Risk tolerance collapses. The future is not abandoned all at once. It's gradually hollowed out. This is why the current spending cycle is so deceptive. It doesn't show up immediately as crisis. It shows up as slower progress, reduced resilience, and narrowing options. The economy absorbs the shock quietly while households lose flexibility in silence. And once enough people reach that point simultaneously, the system becomes fragile. Because an economy built on forward-shifted sacrifices has nothing left to buffer the next disruption. Once future trade-offs are normalized, debt stops functioning as a bridge and becomes the primary power source of consumption. This is the structural shift most analyses miss. Debt is no longer smoothing income, it is replacing income. And an economy that requires constant borrowing to maintain activity is not expanding. It is being artificially sustained. The scale of this shift is staggering. Total U.S. household debt now exceeds $18.6 trillion, with credit card balances alone crossing $1.3 trillion. Interest payments are rising faster than wages, siphoning cash flow before households ever reach discretionary spending. In previous cycles, debt rose alongside asset growth. Today, debt is rising against stagnant real incomes. That is not leverage, it is dependency. What makes this engine so powerful is speed and invisibility. Transactions that once required friction now happen instantly. Buy now, pay later plans fracture prices into psychologically manageable pieces. A $1,200 expense becomes 4 payments of $300, even as effective interest rates quietly rival or exceed traditional credit cards. The consumer experiences affordability. The balance sheet absorbs risk. This mechanism props up retail, travel, and services while masking fragility underneath. If access to revolving credit were removed, a significant portion of current spending would vanish immediately. The economy's apparent momentum is therefore conditional. It exists only as long as lenders extend credit and consumers accept future sacrifice as routine. This is the critical inversion. Debt used to respond to growth. Now growth responds to debt. That reversal changes everything. It distorts signals, inflates confidence, and delays reckoning. But engines that run on borrowed fuel don't stall gradually. They fail suddenly when credit tightens, defaults rise, or income shock interrupts the flow. And when that happens, spending doesn't slow. It collapses. When debt becomes the engine, sales figures stop measuring strength and start measuring distortion. Headline numbers look impressive because they track dollars spent, not value received. That difference matters. In an inflationary system, rising prices can manufacture the appearance of growth even when real demand is stagnant or shrinking. Nominal retail sales continue to post gains, but unit volume tells a different story. Data from major commerce platforms shows prices rising around 5 to 7% year over year, while the number of items purchased remains flat or declines. Consumers are not buying more goods. They are paying more for fewer goods. A $120 checkout replacing a $100 checkout does not reflect improved finances. It reflects eroded purchasing power. Yet both are recorded as growth. This statistical mirage feeds directly into corporate and market narratives. Executives point to revenue beats while quietly managing inventory, cutting labor hours, and slowing hiring. If demand were truly accelerating, capacity would expand. Instead, retailers are cautious, promotional activity is rising, and seasonal hiring has weakened to levels last seen during crisis years. The message beneath the surface contradicts the headline. Inflation also reshapes category mix in misleading ways. Essentials, food, utilities, insurance consume a larger share of household budgets, forcing cutbacks elsewhere. When discretionary categories shrink but essentials spike in price, aggregate spending can still rise. The economy appears active even as choice disappears. Spending becomes compulsory, not elective, but the data does not distinguish between the two. This is why strong sales coexist with deteriorating household balance sheets. Credit card interest rates near 20% convert price inflation into long-term financial drag. Delinquencies rise even as revenues climb. The system records vitality while households absorb strain. Both can be true simultaneously. The danger lies in interpretation. Policymakers and markets read nominal growth as resilience and delay response. Businesses misjudge demand durability and overestimate consumer capacity. But inflation-driven sales are not self-sustaining. They depend on continuous price escalation and uninterrupted credit access. When either slows, the illusion breaks. Strong sales built on higher prices are not proof of recovery. They are a reflection of measurement failure, one that masks weakening fundamentals and sets the stage for sharper adjustments once reality reasserts itself. Beneath the illusion of resilient spending sits a labor market that is quietly weakening in ways headline numbers fail to capture. This is the structural fault line. Consumption can be propped up temporarily by debt and inflation, but income is still the foundation. And that foundation is cracking. The unemployment rate has moved higher, recently jumping to 4.6%, the highest level in more than 4 years. That increase matters not because of the number itself, but because of the speed. A rise from 4.4% to 4.6% in a single month signals deceleration, not stability. Job creation has slowed sharply, with recent monthly gains barely offsetting prior losses. Several months of downward revisions have erased the appearance of momentum. More telling is the composition of employment. The number of people working part-time because full-time jobs are unavailable has surged to 5.5 million, an increase of roughly 900,000 in just 1 month. This is a classic late-cycle signal. Employers reduce hours and flexibility before they eliminate positions outright. Income becomes fragmented, unpredictable, and insufficient to support rising fixed costs. Sector data reinforces the warning. Net job gains are concentrated almost entirely in healthcare and social assistance, areas tied to aging demographics and public funding. Meanwhile, losses continue across manufacturing, transportation, warehousing, temporary staffing, and white-collar roles. These are the income engines that support discretionary spending. Their contraction undermines future demand even as current spending appears elevated. Technology is accelerating this shift. Companies are testing automation limits, consolidating roles, and extracting productivity gains without adding headcount. Even central bank officials have acknowledged that job creation may be overstated by tens of thousands per month, virtually guaranteeing further downward revisions. The labor market is weaker than advertised. This is why rising spending should alarm rather than reassure. Households are increasing financial exposure precisely as income stability deteriorates. That inversion is dangerous. When spending rises on weakening labor foundations, it doesn't signal confidence, it signals strain. And once labor income falters beyond a threshold, debt-fueled consumption doesn't glide lower, it snaps. As labor income weakens, spending does not fall evenly, it hardens around survival. This is where choice begins to disappear. A growing share of household budgets is no longer allocated by preference, but by obligation. Housing, healthcare, insurance, utilities, and food now absorb so much cash flow that discretionary decision-making collapses into constraint management. The numbers are stark. Housing alone consumes 30 to 50% of income for millions of renters, while mortgage payments remain elevated due to prices that still hover near $400,000 and rates that have doubled monthly costs compared to pre-pandemic levels. Health insurance premiums are rising at double-digit rates, with many households facing annual costs exceeding $15,000 to $20,000 before deductibles. Utilities, auto insurance, and property taxes continue climbing faster than wages. These are not optional line items. They are non-negotiable drains. As fixed costs expand, flexibility evaporates. What remains of spending is often misread as discretionary activity, but it is largely defensive allocation. People are not choosing to spend more. They are being forced to spend more just to maintain baseline function. Even when consumption appears stable, the underlying composition has shifted dramatically toward necessity. This crowding out effect has cascading consequences. Savings are sacrificed first, emergency buffers vanish, retirement contributions pause, financial resilience becomes fragile. When a single unexpected expense can destabilize a household, short-term coping replaces long-term planning entirely. The economy transitions from growth to endurance mode without announcing it. Forced spending also explains why restraint no longer materializes during downturns. When essentials inflate faster than income, cutting back elsewhere no longer restores balance. There is nothing left to cut. The illusion of consumer strength persists because dollars are still flowing, but they are flowing through pressure points, not opportunity. This is the final transformation. Spending stops signaling prosperity and starts signaling constraint. The system continues moving, but only because households are carrying more weight with less margin. And once survival costs dominate the budget, the economy loses its shock absorbers, leaving it dangerously exposed to the next disruption. What is unfolding is not confined to one country, one policy mistake, or one economic cycle. The pressure squeezing households is global and synchronized. Across advanced economies, the same pattern appears. Wages lag prices, housing absorbs an ever larger share of income, and basic living costs rise faster than productivity. The result is a compression of living standards that transcends borders. In multiple developed nations, housing affordability has deteriorated to historic extremes. Price-to-income ratios remain near record highs, while rents continue climbing even as growth slows. In countries once viewed as models of stability, surveys now show that only a small minority, often near 10%, report satisfaction with their standard of living. Late bill payments are rising, savings buffers are shrinking. The middle class is being hollowed out quietly, not through collapse, but through attrition. What makes this compression so dangerous is that it arrives without an obvious trigger. There is no single crash moment. Instead, households everywhere are absorbing higher costs simultaneously. Food inflation, energy volatility, insurance spikes, healthcare strain, and housing shortages. Governments respond unevenly, central banks remain constrained by inflation, and fiscal relief loses effectiveness as prices adjust upward. The pressure does not release. It migrates. This global alignment matters because it removes escape valves. In previous eras, regional downturns were offset by strength elsewhere. Today, the same affordability crisis is playing out across North America, Europe, and parts of the Asia-Pacific. Capital flows inflate asset prices, not wages. Mobility fails to restore balance. The system tightens everywhere at once. That convergence sets the stage for the final distortion: how individuals respond when structural solutions disappear. When households recognize, consciously or not, that the system is no longer designed to restore stability, behavior shifts again. Spending ceases to be a forward-looking economic act and becomes a psychological one. At this stage, spending functions as emotional anesthesia. It dulls stress. It restores a temporary sense of normalcy. It creates a brief illusion of agency in an environment where agency has eroded. This is why packed stores coexist with declining well-being. The transaction is no longer about value. It is about relief. Debt enables this behavior to persist. Inflation disguises it. Strong sales headlines legitimize it. But beneath the surface, the logic is inverted. People are not spending because they believe the future is secure. They are spending because the future feels inaccessible. When tomorrow stops feeling real, today becomes everything. This is the most dangerous illusion of all. An economy powered by emotional anesthesia can appear functional right up until it isn't. Spending continues even as resilience collapses. Balance sheets weaken while revenues rise. Policymakers misread signals. Markets delay repricing, and households quietly lose the capacity to absorb shocks. Packed airports are not proof of prosperity. Full restaurants are not evidence of recovery. Record sales do not mean households are healthy, they mean the system is extracting more from people who have less room to give. When spending becomes a coping mechanism rather than a choice, it no longer stabilizes the economy. It accelerates fragility. And once that illusion breaks, once credit tightens, income slips, or costs spike again, the adjustment is not gradual. It is sudden, painful, and unforgiving.